So let's connect with our expert on the show today. And we've been joined by Rahul Sharma, Director Head Technical and Derivative Research at JM Financials. Hi Rahul, great to be speaking with you yet again. Firstly, help us with your take on the markets. Yesterday as well as today, can we call it a day of a consolidation? And from here on, where do you see markets headed?
Yeah, very good afternoon. So indeed, it is a day of consolidation. In fact, broader market has still not given up. So we feel that the current undertone in the market, which turned bullish starting this Monday onwards, continues to remain so. So after the big move, we are seeing a cooling off happening, which is technically very good. And as long as we sustain above the 24,000 mark, we feel that structurally Nifty is very strong for a target beyond the 25,000 mark. So positionally speaking, dips are to be bought into, and we expect the markets to do well. Now, until and unless this range bound trade is not taken, it is better to be stock specific. It is better to look at sectors and stocks which are doing good. On one side, we have metals today trading very strongly. So in the metals peak, we have recommended our clients to buy Hindalco. Hindalco looks good for a target of 700, 725. Can be bought at these levels with the stop loss placed at 630. Another stock which looks good from the small cap space is Lloyd's Engineering. This stock has undergone a rights issue recently. However, we feel that this stock has got a big upside potential, can be bought for an upside of around 30 to 35% over the next 3 to 4 months kind of a time frame. The stock has a very strong base around the 45 area. So 45 can be the stop loss for long positions, and one can look to buy and delivery for a target of 70, 75.
All right, Rahul, this is Kanishka also joining in. Good afternoon. Well, a buy on dips market is what you're suggesting, and you've already named some metal picks. But apart from that, what are some of your other stock picks? How are they looking on the charts?
Yeah, so if we look at the broader market, one thing that is clearly standing out is the PSE space, public sector enterprises. Now, this was the first sector to get into a correction even before the markets got into a correction last year, somewhere around October, November. And now, we feel that a bottom is in place, and the PSE as a sector can do well. We are seeing the defense companies doing very well. Railway companies also are seeing traction building up. So if you are an investor, I think the best thing to do is to buy the CPSE ETF, which can be a good vehicle to play the entire sector. So CPSE ETF is trading around 90 rupees. The previous stop was around 110. So good upside can be had over the next 6 months period, and this ETF can be purchased to participate in the broader rally that you are expecting in the PSE space. So PSE as a space remains our top pick. Metals from the momentum space and capital goods, especially the smaller rung names, can do well from an investment perspective.
But Rahul, does that mean within the PSE basket, one should stay away, or rather not a great time to look into the banking counters? Because for the past couple of days, the bank nifty as well is drifting lower.
Yeah, so banks and financials have led this rally. There is no doubt about that, and this is merely a cooling off that is happening over the last few couple of weeks. Odd. We feel that sooner than later the bank nifty should play catch up, and if you look at the inherent strength that banks have, they still continue to be head and shoulders above the rest of the market. So if a dip happens again around the 24,500, 24,400 mark, one can look to add banks and financials as well. So, we continue to remain overweight on the banking and financial space, and we feel that there is more upside to be had in the short to medium term.
Thank you, Rahul. Thank you so much for joining us this afternoon and helping us understand the market moves and your top picks at this point in time.
If you like this video, then like, share and subscribe to ET Now.